You are now listening to the Hustle Report with Jason Malone, presented by Clicks Media.
Today we're going to talk about ETFs and index funds in depth. ETFs and index funds are two popular investment options for beginner investors who want to get exposure to the stock market. They are low cost, easy to buy and sell, and provide instant diversification. Let's start by discussing what ETFs and index funds are and how they work. So ETFs, or exchange traded funds, are similar to mutual funds, but they trade like stocks on an exchange. ETFs are designed to track a specific index, such as the S&P 500, and their value changes throughout the day as the underlying securities in the index change. When you buy an ETF, you are essentially buying a basket of stocks that track a specific index. Index funds, on the other hand, are mutual funds that are designed to track the performance of a specific index, such as the S&P 500. Index funds are not traded on an exchange, but are bought and sold through a mutual fund company. When you invest in an index fund, you are essentially buying a share of a mutual fund that tracks a specific index. Now let's discuss the benefits of investing in ETFs and index funds. One of the biggest benefits of ETFs and index funds is diversification. By investing in a broad-based ETF or index fund, you can get exposure to a variety of stocks and industries with a single investment. This can help to reduce your risk of losses, as the performance of one company or industry won't have a significant impact on your overall portfolio. Another benefit of ETFs and index funds is low cost. ETFs and index funds typically have lower management fees than actively managed funds, which can eat into your investment returns over time. The lower fees associated with ETFs and index funds can help to boost your overall investment returns. When it comes to investing in ETFs and index funds, there are a variety of options available. You can choose to invest in broad market index funds, such as the S&P 500, or you can choose to invest in more targeted index funds, such as technology or healthcare. As a beginning investor, it's important to determine your investment goals and risk tolerance before investing. You can then allocate your capital accordingly to ETFs and index funds that align with your investment goals and risk tolerance. One income strategy for investing in ETFs and index funds is to reinvest the dividends. Dividends are a portion of a company's earnings that are paid out to the shareholders. By reinvesting your dividends, you can compound your investment returns over time and potentially build wealth faster. Another income strategy is to invest in high dividend yield ETFs and index funds. These funds focus on companies that pay high dividends and can provide a steady stream of income to investors. Now let's discuss how you can build wealth by investing in ETFs and index funds. Investing in ETFs and index funds is a long-term strategy. By investing consistently over time, you can potentially build wealth through the power of compound interest. Compounding is the process of reinvesting your investment returns, which allows your money to grow at an exponential rate over time. It's important to remember that investing in ETFs and index funds is not a get-rich-quick scheme. It takes time and discipline to build wealth through investing. However, by investing consistently over time, you can potentially achieve your financial goals and secure your financial future. Now let's discuss the types of ETFs and index funds available to investors. Broad market index funds, such as the S&P 500, are designed to track the performance of a specific index, which represents a broad cross-section of the stock market. These funds are a good option for beginning investors who want to get exposure to the overall market. Next, we have sector index funds. Sector index funds focus on a specific industry, such as technology or healthcare. These funds provide more targeted exposure to specific sectors of the stock market. Next, we have international index funds. International index funds invest in stocks from companies located outside of the United States. These funds can provide exposure to companies in developed and emerging markets around the world. Bond index funds. Bond index funds invest in a diversified mix of bonds such as government and corporate bonds. These funds can provide a steady stream of income and help to balance the risk in your investment portfolio. Factor-based index funds. Factor-based index funds focus on a specific investment factor such as value, growth, or momentum. These funds can provide exposure to companies with certain characteristics that have historically outperformed the overall market. Now let's discuss the factors to consider before investing in ETFs and index funds. What are your investment goals? Before investing in ETFs and index funds, it's important to determine your investment goals. Are you investing for the long term or the short term? What is your risk tolerance? Knowing your investment goals can help you choose the right ETF. Fees. Fees can eat into your investment returns over time, so it's important to choose low-cost ETFs and index funds. Compare the expense ratios of different funds and choose the one with the lowest fees. Diversification. Diversification is key to reducing your risk of losses. Choose ETFs and index funds that offer exposure to a variety of stocks and industries. Then we have tax efficiency. ETFs and index funds are generally more tax efficient than actively managed funds. Look for funds that have low turnover and are designed to minimize tax liabilities. Now let's discuss how you can build wealth through investing in ETFs and index funds. Investing in ETFs and index funds is a long-term strategy. By investing consistently over time, you can potentially build wealth through the power of compound interest. Compounding is the process of reinvesting your investment returns, which allows for your money to grow at an exponential rate over time. Another key to building wealth through ETFs and index funds is to maintain a disciplined approach. This means staying invested through market fluctuations and avoiding the temptation to make emotional decisions based on short-term market movements. Finally, consider automating your investment contributions. Setting up automatic investments can help you stay on track with your investment goals and ensure that you're consistently investing over time. In summary, ETFs and index funds are great investment options for beginning investors who want to get exposure to the stock market. They offer instant diversification, low cost, and a variety of options for investors. When investing in these funds, it's important to consider your investment goals, fees, diversification, and tax efficiency. By investing consistently over time and maintaining a disciplined approach, you can potentially build wealth through the power of compound interest. This episode was brought to you by Clicks Media, where we're focused on giving you the tools and information that you need so that you can launch and scale your business. We build websites, we build mobile apps. We can help you also create the content strategy for your brand. All right, guys, thank you so much for tuning in, and I will see you on the next episode.